We go to chapter 38, Economics AS, possible conflicts between macroeconomic objectives. When we talk about conflicts, it's simply talking about trade-offs based on, there's macroeconomic objective, which means government will come up with different policies to achieve certain objective. So in the course of coming up with these policies,
There's conflicts.
there's going to be conflict. So that means for you to get one, you have to do away with another. So that is
Opportunity cost.
no trade-off. Because opportunity cost is the next best alternative for grant. For opportunity cost, you're choosing one. But here, the benefit of one stops you from getting the benefit of another. That's why we call it trade-off. I think you get the difference here.
Yes.
So, possible conflict between macroeconomic objectives. Macroeconomic objectives include high and sustainable growth. We want the growth of a country. We want our economic growth to increase. And not just to increase, to be sustainable. So there is difference between increasing your growth and sustaining your growth. If you are increasing your growth, your long aggregate supply curve and the short-term aggregate supply curve and the aggregate demand are at the same point. When it becomes sustainable, it means you are able to improve it or increase it at the same rate. That is what sustainability is about. Low unemployment. With low unemployment, it means the economy is already moving towards full employment. That's also an objective of the government. Low inflation. The government or the economy should have price stability. A sustainable current account equilibrium on the balance of payments. So your balance of payment current account should always be at equilibrium, which means export does not exceed imports. They are balanced. That's it. And always improving on it. A sustainable fiscal position. Government expenditure through taxation, because government will spend from tax revenue, yes or no? So government revenue and expenditure must equal that fiscal position. I think it's clear. Environmental objectives, pollution, global warming. The environment should be a better place. That's it, and not using up all resources. Trying to use renewable resources. The objective relating to income and wealth inequality, wealth equality. So here we're talking about finding a way to reduce the gap between the rich and the poor. These are all macroeconomic objectives which government would want to achieve. But in the course of trying to achieve one, it brings about not being able to achieve another. That is the point there. So we start. A successful and sustainable economy. I wrote, an economy is considered to be successful if the aggregate demand is equal to short-run aggregate supply and long-run aggregate supply. So we call the economy successful because it's able to maintain the same aggregate demand at the same point with short-run aggregate supply and the long-run aggregate supply. Though may have a structural unemployment, but there's full employment in all regions and in all industry within the economy. So an economy might be successful, but it doesn't mean that there's no structural unemployment. Now, when we talk about structural unemployment, this is unemployment that comes as a result of decline in one aspect of the sector of the economy. So it is possible that, the agricultural sector of Libya is in decline. That will bring about structural unemployment. But it doesn't mean Libya is not successful. But it only lets us to understand that on that sector, we are having decline. And the decline brings about unemployment. So now, the sustainability of an economy lies in its ability to increase its aggregate demand and its match with an increase in both aggregate demand, in both SRAS and long LRAS with a mild inflation, and it's able to use the growth to finance environmental improvement. So it becomes sustainable because the economy has been able to move based on the graph we're having here. The economy has been able to move from the AD1 to AD2. And at the same time, the short-run aggregate supply curve has matched the long-run aggregate supply curve. So listen, the aggregate demand has increased, but not the same rate as the short-run aggregate supply and the long-run aggregate supply. But both the long-run aggregate supply and the short-run aggregate supply are able to meet at that point. So with this situation, the economy becomes sustainable. But the point is that as soon as this occurs, the price level is expected to rise a bit. We call it mild inflation, which is important. So it's still around 2% inflation rate. But if that happens to an economy, then we could say the economy is successful and sustainable. Do you get it? And it becomes sustainable because the growth of the economy has allowed the economy to have income that's able to use in financing the environment, the improvement in the environment. So we have a sustainable, successful environment economy because it does not only based on its output, also because the environment becomes conducive for people. I think the points are clear.
Sure.
So that's the graph we have there for the short run. The long run, aggregate demand, the long run aggregate supply, and the short run aggregate supply. So it's sustainable, it's successful at Y1, it's sustainable at Y2. So that's the point. I think it's clear. Is it clear, please?
Okay, I have a question.
Okay, yes.
What does the area between these two, what do we call it?
No, it's just the margin. It's the mild margin between that brings about the inflation. Because here in the movement, the AD1, AD2, AD1 is moving towards this, but the short-term aggregate supply is going backward. That's leftward, right? And the long aggregate supply is moving. But both of them are moving to the same point, but different from the aggregate demand. So there's mild inflation here, based on the fact that the aggregate demand is moving to the right, but the short-term aggregate supply is moving leftward to meet the long-run aggregate supply, which is moving rightward. So the short run is moving leftward a bit, but the movement towards the left is as a result of going towards the LRAS. So that means whatever happens to SRAS and LRAS, AD is positive to them. So that's the difference. So the difference here will increase the price from P1 to P2.
Okay.
Is it clear now?
Yes.
SRAS1 to SRAS2, that's a leftward shift. But there's a rightward shift from LRAS1 to LRAS2. And there's a rightward shift from AD1 to AD2. So the point is that the aggregate demand has increased further a bit than the short-run aggregate supply and the long-run aggregate supply. But both LRAS and SRAS are meeting at that point, and that increases the price.
Okay.
So the price increased because the short-run aggregate supply is moving towards the left. So that brings about a mild inflation.
Okay.
Clear now?
Yes.
Good. Okay. Okay. Are we done with that?
Yes. This
No,
page
okay. We're going to conflict now, right?
Yep.
Okay, yes. So we're going to conflict. Now we're going to conflict, right? Conflicts between macroeconomic objectives. So we're going to start with inflation and unemployment. Here, there's trade-off between inflation and unemployment. A high inflation can be reduced through aggregate demand. Reducing aggregate demand can be either cutting consumer spending or government spending. This is likely to lead to recession or cyclical unemployment. Now, inflation and unemployment, they have inverse relationship. That is the trade-off. So they said there's a trade-off. So a high inflation, if there's a high inflation rate, the best way to solve that is to reduce aggregate demand. And when you are reducing aggregate demand, it means you are reducing demand within the economy. To reduce aggregate demand, it's either we cut spending of consumers or government spending. So either government spending reduces or consumer spending reduces. That is the only way to reduce high inflation rate. So as soon as consumption reduces or government spending reduces, demand pull inflation would reduce. And that is how to solve inflation rate. In the course of solving that, because consumption reduces and government spending reduces, firms will not be making as much as they used to make. And because they're not making as much as they used to make, recession will come into the economy and unemployment will come. It's cyclical unemployment, which is unemployment based on aggregate demand. Because aggregate demand is falling. If aggregate demand falls, it will lead to cyclical unemployment and recession because firms will not be able to employ further. They are not making revenue. It is only when they make more revenue and demand is increasing that they will think about employing more workers. So it's cyclical. But now, demand is falling. Revenue is falling. They have to lay off workers because they're not making revenue. So there's always going to be a trade-off between inflation and unemployment. A high inflation will be solved by reducing aggregate demand. To reduce aggregate demand, we need to reduce consumption or government spending. On the other hand, if the rate of economic growth is too low, one way to increase it is, in the short run, is to increase aggregate demand. So when you increase aggregate demand, this will lower unemployment. And as soon as unemployment reduces, what happens again? Prices would rise because demand would increase. And if demand increases, it leads to demand pull inflation and also cost push inflation because if demand increases, firms would want to employ more workers. And the economy is always moving towards full employment. And because the economy is moving towards full employment, the demand for labor would increase more than supply of labor. So firms will not have any other choice than to pay more to their workers. So that increases their cost of production. So that increases cost pushing. That brings about cost push inflation and demand pull inflation. So that's why we have the short-run Philip curve here. So for the short-run Philip curve, when you look at the graph shows that the lower the unemployment rate, the higher the rate of changes of money wages in which is a proxy of measure for inflation. So look at the okay. Look at the Philip curve here. This is money wage, which can be used, is a proxy, that means is an indirect way of measuring inflation. So if this unemployment rate, if the unemployment is reducing, the wage rate, inflation rate will rise. So if unemployment is reducing, inflation rate will rise. If unemployment is increasing, inflation rate will fall. So that is the short run, I guess, or the short run Philip curve. I think the point is clear. It only shows the relationship that is there between unemployment and the rate of money wages, which is a proxy for inflation, in measuring inflation. Any question about inflation and unemployment? Good. So note, the trade-off between unemployment and inflation is in the short run. Therefore, it won't exist if supply-side policies were used. Now, we already said there's trade-off between inflation and unemployment. That is why we use the short-run Phillips curve to explain it. Inflation and unemployment are traded off in the short run. But when it comes to the long run, in the long run, there's government intervention, yes or no?
Yes, sir.
Which is supply-side policy. So with supply-side policy is expected to increase output within the economy. And if output is increasing, inflation rate is expected to fall, yes or no? So here I wrote, therefore, it won't exist if supply-side policies were used. As supply-side policies increase the long run aggregate supply, so the price level falls and the real GDP rises. A rise in real GDP means unemployment is expected to fall. So in the long run, we won't have a trade-off between inflation and unemployment because there's going to be the possibility of using supply-side policies. And when you use supply-side policies, it increases the long run aggregate supply. And if the long run aggregate supply curve is increasing, it's shifting to the right, it simply means the price level is expected to fall and aggregate demand is expected to increase. So the short-run trade-off between unemployment and inflation can be expressed also with the classical economist short-run aggregate supply, which is this. So it's only in the short run, either we use the Phillips curve or the classical economic short-run aggregate supply. So in the short run, output, the aggregate demand is increasing from 81 to 82, but just in the short run. So it's always going to be in the short run. So this is the only time we have unemployment, in the short run. But in the long run, government will use supply-side policies to increase the long run aggregate supply. And if the long run aggregate supply is increasing, they won't even need to think about short-run aggregate supply because now we're thinking about sustainability and success.
Yes,
Is it clear?
yes, sir.
So that's about inflation and unemployment. You have to put in mind that there's trade-off between inflation and unemployment only in the short run. Why is it not possible in the long run? It is not possible in the long run because in the long run, there's always supply-side policies. And whenever supply-side policies are in place, it increases long-run aggregate supply. Any question about that?
No.
So that ends inflation and unemployment. So the next one is economic growth and equilibrium on the current account, right?
Yes, sir.
Yeah. So the next one, economic growth and equilibrium on the current account balance of payment. We know what the current account is, balance of payment is, right? So yeah, if economic growth is too low, in the short run, the government might increase aggregate demand. This is likely to lead to a rise in imports because increased incomes will lead to extra demand for imported goods. If there was originally an equilibrium on the current account, this will lead to deficits. So it's always going to be based on assumption. So if the government figure out that the growth of the economy is too low, so the next thing to do is to increase aggregate demand. And note that aggregate demand, when we talk about aggregate demand, the component of aggregate demand also involve importation. So if aggregate demand is increasing, importation is likely to increase. And if importation increases, it means import exceeds export. And that will bring about a deficit in the balance of payment. If the balance of payment is already at equilibrium, equilibrium means export is equal to import. That means they are the same point. But as soon as import exceeds export, it brings about deterioration to the balance of payment current account. And as a result of that, there will be deficit. Do you understand the first way in which we have deficit? Okay. Also, if imports are far greater than exports, this might bring about difficulty financing these deficits. Cutting import by reducing domestic consumption and investment will reduce demand for goods produced domestically. This will bring about a fall in real GDP and a rise in unemployment. Now, on the other hand, so there's also a trade-off here. If import exceeds export, one way to reduce that is to cut spending or to cut importation. Cutting importation means firms that rely on importation of raw materials will not be able to get raw materials at a cheaper rate. And what does that mean? It means the price of domestic goods will rise. And if the price of domestic goods increases, that's inflation again. If the price of domestic goods increases, the real GDP of the economy would fall. And also unemployment would rise. Do you see how it works here?
Yes,
So
sir.
that is economic growth and equilibrium on the current account balance of payments. So note the trade-off now. The trade-off between, okay, I think that's it. Yes, that's about economic growth. However, are you with me, please? However, if the current account is in deficit, the use of supply-side policies would achieve growth, lower inflation, and reduce current account deficit. This is because domestic goods will be more price competitive in international markets. However, in the long run, everything that we talked about here is still in the short run. In the long run, we use supply-side policy. And when we use supply-side policy, it simply means that growth will be able to be achieved because inflation will be less, inflation will reduce, demand current account deficit would also fall, and the demand for domestic goods would rise. And if the demand for domestic goods increases, it means the country becomes internationally competitive. And if the country becomes internationally competitive, export rises further than import. And it means if the balance of payments current account is in deficit, it starts improving to come to equilibrium. Is it clear?
Yes.
So that means we have deterioration in the balance of payment current account in the short run, not in the long run. I think it's clear. Any question about balance of payment current account equilibrium?
Yes.
No. Question?
No.
Okay. Then the next one is economic growth and income inequality. Are you there?
Yes.
Now we go to economic growth and income inequality. Here I go. Government intervention may be needed to correct inequalities. This can be done by redistributing income through taxes and government spending. So when we talk about economic growth and income inequality, we're simply talking about growth, and mostly when growth involves the capitalist, it means the low and middle income earners will be worse off. So that's why they say, most of the time they say economic growth brings about inequality. So as soon as there's inequality, there's need for government intervention. So government intervention will bring about maybe increasing taxes for the rich, which is called progressive taxes,
And reducing
or
taxes.
increasing spending, like unemployment benefits, government spending, to make it to reduce the gap between the rich and the poor. Do you get it or not?
No, I don't get it actually.
Okay. What I'm saying is
Let
we
me.
have equality, right?
Mhm.
Okay. Income equality. Now, economic growth might bring about income inequality. And as soon as there's income inequality, the next thing is government intervention. So with government intervention, government will aim to reduce the gap between the rich and the poor. So to do this, government might do it through taxation or subsidy. Taxation. Now let's talk about taxation. Government might introduce progressive taxes, charging higher taxes on the rich by now distributing it to the poor, or increasing spending. Increasing spending in terms of unemployment benefits, which allows the unemployed and the low-income earners to earn more. So they will be able to afford those things that the rich can afford. That is how to reduce the gap between the rich and the poor. Is it clear now?
Yes, sir.
Great. Also, inequality can be reduced through setting minimum wages or giving trade union more power. Besides taxation and subsidy, another way to reduce income inequality is through setting a minimum wage. So as soon as minimum wage is set, it means firms will not be able to pay lesser than the legal wages that they are supposed to pay. It becomes illegal to pay below it to the least employee. So that can also reduce the gap between the rich and the poor. Yes or no?
Yes, sir.
And the last one here is giving the trade union more power. By giving the trade union more power, it means they have the ability to influence employers to pay more to their members. So by doing that, then the gap between the rich and the poor, because if the trade union has more power, it increases their ability to negotiate for higher wages for their members, and that increases the income for the members. Do you get it here?
Yes, sir. Yes, sir.
So that might reduce inequalities. So by likewise, it benefit for the unemployed. So it's like now, they said, economists argue that reducing inequality by large rises in benefit for unemployed is likely to have some disincentive effect to work, and this in turn increase long-term unemployment. Now, according to economists feel that inequality is important because with income inequality, it is an incentive for people to start thinking like entrepreneur, to start thinking about working so that they can meet up with those that are earning more than they do. So if government starts finding a way to reduce the gap between the rich and the poor, it will bring about an increase in long-term unemployment. Because if unemployment benefit increases further than the normal minimum wage, then there's no point for me to work.
Yes.
So I could as well sleep at home and get paid by government.
Mm-hmm.
That would increase long-term unemployment. And if long-term unemployment increases, it reduces real GDP within the economy. Do you understand?
Yes, sir.
So therefore, some policies that promote growth do conflict with equality. So if government is coming up with finding a way to reduce the gap between the rich and the poor, it will also bring about reducing the growth within the economy. Because if people do not work, it simply means output within the economy would fall. If output is falling, growth will fall, will be in decline. So there's conflict here. There's a trade-off between inequality and growth. Equality and growth. If government wants to reduce inequality, it might as well reduce growth. Is it clear?
Yes.
Okay, I think I talked about that. Okay, they said therefore some policies that promote growth do conflict with equality. For example, free market supply side policies such as reducing trade union power, making wages flexible, and making it easier for firms to sack workers are likely to put down pressure on wages. So there's always going to be trade-off. If trade unions are powerless, it simply means they won't be able to negotiate for higher wages. Yes or no?
Yes, sir.
That gives employers more power to sack workers. Yes or no? So if that happens, unemployment will rise as a result of that. Yes or no? And at the same time, the economy will grow. Isn't it?
Yes, sir.
So whatever policy that comes in, there's always going to be a trade-off. So the benefit of reducing the gap between the rich and the poor is a trade-off of not benefiting in economic growth. Is it clear? So the trade-off for reducing the gap between the rich and the poor is economic decline. Is it clear?
Got it.
Any question about that? Good. So that takes us to
growth and protection of the environment.
Yes. Economic growth and protection of the environment. Okay. So economic growth and protection of the environment. I wrote in developing countries, growth in both the primary and secondary sector is likely to increase pollution and cause other environmental damage. Now, because we have different economies, we have different countries, and we have different stages in their development. We have developing countries, we have developed countries.
Emerging countries.
Emerging countries too, we have them. So emerging countries are countries that are moving towards the tertiary sector. They are moving towards the tertiary sector. That's emerging countries. You got me? So after that, they become developed. Okay. Like countries like Nigeria, South Africa, they are emerging countries. Mexico. So for in developing countries, they mostly rely in the secondary sector, and for developing countries, they mostly rely in the secondary sector and the primary sector for their growth. But here, with growth in the secondary and primary sector, it is likely to bring about environmental damage. That is the first point there. Yes. So in these economies, the main macroeconomic objective is economic growth, as this is crucial to lift their population out of poverty. So for developing countries, their macroeconomic objective is growth, because that is the only way out of poverty for their large population. So they won't think about damage that the environment will bring about. presently. They won't think about it. They just want growth because they have to leave poverty. However, in rich developed countries, the economic growth should improve their environment because they have the capacity to invest in advanced technology that is environmentally friendly. For developed economies like Germany, the UK, the US, uh, Italy, they have the ability, they have the financial capability to invest in technology that would be environmentally friendly. So we won't think about environmental damage for them. I think the point is clear there. So therefore, investing more resources for cleaner environment will reduce economic growth of developing economies because they are investing on resources that will rather improve the environment than output. So for developing economies, the point is, if we start thinking about channeling resources into improving the environment, it means we stop thinking about using our resources for output. We start thinking about using our resources in respect of environment. That will bring about low economic growth, and that will put them back into poverty. Do you get it?
Yes, sir.
So this situation can be solved if investment is done with the use of renewable resources. So to solve such problem, we need to start thinking about developing countries should start thinking about using solar, wind for their to increase their output. That is the only way out. If not, they will continue to damage the environment. Therefore, okay, so it means the only way out is to start thinking about renewable resources. If we start thinking about renewable resources, that would increase our aggregate demand. So if aggregate demand is increasing, then we can come up with using environmental friendly technologies. But we need to start thinking about other ways around not using non-renewable resources. So also environmental policies can force inefficient firms to become more efficient, as this may also increase non-growth aggregate supply curve. But we have to also think about government, because damage to the environment is a market failure. So government intervention is important. So if government is intervening, it might also allow firms that are inefficient to become more efficient, because they know that if they continue to damage the environment, they continue to pay financial penalty, which is not good for them because it will continue to reduce their profit. So maybe environmental policies might bring about efficiency for firms, and that would improve the environment. I think environment is clear there.
Yes, sir.
Good. Then we have inflation.
We did this.
Yeah. So we have inflation, right? Okay. So for inflation, inflation and equilibrium on the current account balance of payment again. So if the current account of the balance of payment is in equilibrium, and inflation is too high, the central bank of an economy is likely to raise interest rates. The central bank of a country always sets what we call inflationary gap. So they want to ensure that there's price stability. And to ensure there's price stability, it means they have to monitor the price every now and then. That's why they set what we call inflationary time. So if the BOP is in equilibrium, that means export equals to import, and inflation is too high, the central bank of the economy would use interest rate to reduce inflation. And what is interest rate? Interest rate is the price of money. That means the price of saving or the price of borrowing, right? So this will reduce aggregate demand, which will in turn reduce demand pull inflation. If government wants to reduce inflation, government could use interest rate. And if interest rate is used, it means aggregate demand would fall. And part of the component of aggregate demand is importation. Do you understand that?
Yes.
So that reduces importation, which will lead to current account moving towards surplus. So as soon as importation reduces, it means the aggregate demand within the economy would rise, and the balance of paper current account is expected to move to surplus, because it means export will exceed importation. Do you get the point here?
Yes.
So the surplus will also arise because a fall in inflation allows exports to increase. If inflation rate falls, it means domestic prices reduces, yes or no? That makes a country to become internationally competitive. Export will be more than imports, and that can also bring about what? Surplus in the balance of payment current account. I think the point is clear there.
Yes.
Also, if inflation is too low, a central bank a central bank lower interest rates, if inflation is too low, the central bank can also reduce the interest rate. As soon as the central bank reduces the interest rate, what happens? Demand for goods and services would rise. And if the demand for goods and services rise, it will increase what demand pull inflation, because inflation is important. If not, the economy will go into what we call deflation, and deflation will bring about the recession. Do you understand? So it is important to always stabilize price. So a low inflation, please. We're back here now. So a low inflation rate, if the inflation is too low, the government of the central bank will lower the interest rate. As soon as the central bank lowers the interest rate, it increases borrowing within the economy. And if borrowing increases, investment will also increase. Aggregate demand is expected to rise. And if aggregate demand increases, demand pull inflation would rise again, would increase. So this will bring about a rise in the price of domestic goods, which will result to domestic goods becoming less price competitive compared to those from abroad. Export will fall. This will also lead to increase in demand for imports. This combined effect means current account will deteriorate. So the other way around, if the central bank figure out that the inflationary target, the inflation rate is below the inflationary target, that is the point. That if inflation is too low, a central bank lower interest rates. So the point is this: if inflation is too high, the central bank will do what? If the inflation rate is high, it means price for goods and services will increase. The central bank will what? Will rise interest rates. If it increases interest rates, what happens? Prices would borrowing and spending. Borrowing would fall, saving would rise. Yes or no? Because interest rate is the price of money. So as soon as the central bank figure out that the inflationary gap or the inflationary target, the inflation rate is above the inflationary target, that is what we call high inflation. The inflation rate is above the inflationary target. If it's above the inflationary target, the central bank will increase the interest rate, and that reduces demand pull inflation. And if the inflation rate is too low, the central bank will reduce the interest rate. Reducing the interest rate means the price for money would fall. People will borrow more, and that will bring about increase in aggregate demand. So if aggregate demand increases, what happens? People will be able to borrow more. If aggregate demand increases, domestic prices would rise, and that would lead to what? Deterioration in the balance of payment current account. So either ways, if you are trying to reduce interest rates, it might bring about, if you are trying to reduce interest rate, it might bring about deterioration in this balance of payment current account. And if you are trying to increase interest rate, it will also bring about deterioration in the balance of payment current account. So what a country has to do is to figure out how to make sure things are balanced. And to do that, the central bank must always set an inflationary target. So as soon as the inflationary target is set, maybe 2.5, it's set. As soon as anything wants to happen, the central bank would know and would quickly, will quickly respond towards that to not allow it to go high or to go too low. Any question about that?
No.
So that ends possible conflict between macroeconomic objectives, right? Thank you. Long topic though. Short, but
Not
more
long like the
other ones, yeah.
chapter, I think 35 or 36, 30 pages.
30, yeah.